In case you haven't noticed, the stock market is crashing. Now, even if I somehow didn't hear that phrase when I was watching the news or scrolling through my Instagram feed or talking to my friends and family, I would have definitely realized it when I opened up my investment portfolio and saw a much lower amount in there than I had just a few days earlier. Now, I actually want to show you guys my personal investment portfolio so you can see a real life example of what's been going on. So this is my investment portfolio as of April 3rd. And by the way, it was already on its way down at this point. You can see that when I took this video, it was sitting at $159,000 across all of my different accounts. Then the very next morning, so on April 4th, this was my investment portfolio. So you can see that it was down to about $153,000 just one day or one overnight later. Then we had the weekend in between, and the markets aren't open on the weekend, so nothing was happening until Monday morning. So we're at April 7th now. I woke up and saw that my investment portfolio was now sitting at $144,000. Yes, so that's over a $15,000 plus swing in just between April 3rd and April 7th, going from $159,000 to $144,000. And it's been really crazy and rocky ever since then. Literally by the time the markets closed on April 7th, my portfolio was already back up to $150,000, and then it's just been up and down since then. It's been to $153,000, then back to $148,000. It's just been bouncing all over the place. Now, this is actually the first time that I've experienced this level of volatility inside of my investment portfolio in my entire life, especially considering the amount of money that I have in there right now. To give you some context on that, I didn't really start focusing on investing until the beginning of 2021. And if you can think back to and imagine that time, it was still the first year of COVID. If you look at a graph of the stock market, and I'll use the total US stock market for example here, you can see that this was after the big stock market crash that happened around March 2020. So I got into investing for real when the stock market was already on the rise again. Now, there's definitely been some volatility between 2021 and now in 2025. Specifically in 2022, we can see that the stock market did dip down a little bit, but for the most part, it's been on a pretty steady rise over the last 4 or so years now. So what that means is that I've mostly experienced my investment portfolio going up steadily. And I've been consistently investing both on a monthly basis and then extra lump sums whenever I have a bonus or a tax refund, something like that. And then the investments that I've been purchasing have been going up in value too. Until recently when everything changed and the stock market started crashing. And from everything we've been hearing, it seems like it's going to continue to crash or at least go up and down for at least the next little while. So in this video, we're going to go over what you need to know, what you need to do, and how this actually impacts you.
Okay, so like Steph was saying, we clearly saw a stock market crash last week with our own eyes. Now, technically speaking, a stock market crash is a steep and sudden collapse in the price of either an individual stock or of the broader stock market. So if we look at the S&P 500 as an example, you can see that it was down by over 10% in the span of 5 days. So that would be considered a stock market crash. And the S&P 500 is just an example. We could look at a bunch of different individual stocks or different parts of the global stock market and see the same thing. Now, one thing that I want to mention is that a stock market crash is different from a bear market. If you haven't heard that term before, a bear market is when a financial market is down by at least 20% from a recent high point, and it usually has to be over the span of several months. So a stock market crash is a sudden and steep collapse of 10% or more, so it can be quick, and a bear market is a slower decline of at least 20%, so it's sustained over a longer period of time. That means that we saw a stock market crash, but we're not in a bear market yet. And it's important to note that not every stock market crash leads to a bear market down the line. There's been times in the past when a brief stock market crash didn't cause a bear market, but it's really dependent on what's going on in the economy that originally caused the stock market crash. Now, keep in mind that if we do enter a bear markets are normal and are a part of the market cycle. There's actually been 27 bear markets in the S&P 500 index specifically since 1928. And on the flip side, there's been 28 bull markets since we're always in one or the other. Either we're up or down, or we're in a bear market, or we're in a bull market. Now, bear markets usually go by much quicker than bull markets. For instance, the average bear market is only about 9 months long, whereas the average bull market is over 2.5 years long. Keep in mind that that's the average length of time. Each individual bear or bull market could be longer or shorter, but the main takeaway is that bear markets are normal and they don't last forever. Also, because the market's always flipping back and forth, you can expect to live through many different bear markets. And if you're investing for decades, then you're gonna be investing through many bear markets and you're gonna see your portfolio go down in value.
Now, the other phrase that we've been seeing a lot in the news over the past week is that a recession is looming. A recession happens when there's a significant decline in economic activity, so things like trade and industrial activity have gone down, and one marker to officially declare a recession is when a country's GDP has fallen for 2 quarters in a row, so for half a year. Now, recessions aren't a fun time because depending on what exactly caused them, there's usually layoffs in certain industries, and just the economy and society overall is a whole mess. Now, just like how stock market crashes don't always lead to a bear markets also don't always lead to a recession either. Like Dennis mentioned, there's been 27 bear markets since 1928, but there's only been 15 recessions in the US specifically during that time period. So even if stocks are down in value over an extended period of time, it doesn't necessarily mean that the overall economy is going to be in a recession. Now, right now is an interesting time because all of the uncertainty that's happening in the stock market is related to the economy and economic policy. It's directly tied to the US president placing tariffs on a large number of countries around the world. Now, there's a lot of details and factors that go into this, but from a very high level, tariffs are essentially taxes on products from other countries that are put in place by a government. They end up being an extra cost added to foreign products when they enter a country, and they're in the form of a percentage of the price of the product. So for example, if a tariff is 10% and I'm bringing in something worth $30,000, there's an extra $3,000 added to the total cost. Now, a government could impose tariffs for a few different reasons, like to make more money, to correct trade imbalances, or as a political tool to get other countries to do what they want. Now, the thing about tariffs is that it's not really as simple as you pay 10% more. Typically, businesses, in order to actually afford these extra costs, or maybe to keep their profit where it is, they'll simply increase their prices, which just pushes these extra costs onto the consumers instead. It also impacts small businesses, including ones that are based in the country that are imposing the tariffs, because let's say that they actually import their products from other countries because it's cheaper, but now it's no longer cheaper because of the tariffs, but it still costs a lot of money and is really expensive to create their products in their country, then they might just have to shut down their entire small business because it's no longer affordable for them. Basically, all of these short-term impacts lead to a lot of uncertainty and changes for both businesses and consumers, which of course impacts the economy and therefore, in theory, could lead to a recession. Now, we can see that that hasn't happened in the US yet, but I think the question on everyone's mind is, will it happen later this year? And the answer is that it's really hard to predict, especially with so many changes happening right now to economic policies and just changes in general. Like just a few days after the tariffs were imposed and announced, they ended up pausing them again. Now, when the tariffs were paused again, we actually saw the stock market surge back up again, and we saw the 8th best day in stock market history on April 9th. Now, the S&P 500 specifically saw one of its biggest gains since World War II. And what that means is that it went up 9.5%. And even though the stock market is still priced lower than it was a few weeks ago, it's still up 9.5%, which is a very big one-day increase.
So what does this mean? Well, it means that we don't really know what's going to happen next and we don't have a lot of control over it. It also means that there's a lot going on in the economy and in the stock market. And during these times of uncertainty, people tend to think irrationally, they panic, and they make mistakes. There's actually a few different things that people and investors specifically tend to do during this time. One, they panic about their investment portfolios going down and they sell their investments at a loss. Two, they're concerned about their investment portfolios going down and instead of selling their investments, they simply do nothing and stop purchasing investments. Three, they know that this is a regular part of the stock market cycle and they start buying more investments than they usually would. Or four, they know that this is a regular part of the stock market cycle and they continue with their regular investment strategy as they normally would. Option number one, for the most part, is the worst thing you can do during times of economic uncertainty when the stock market is crashing. When your investments are down in value, you haven't actually lost any money. Just like how when your investments are up in value, you haven't actually gained any money. Now, this is because, as we can see with the markets right now, they're subject to go back down in value again. You only lose or gain money from your stock market portfolio when you sell your investments. When you sell your investments, you're realizing the value of them. So pausing them at that exact time and taking the current cash value of them. So you no longer have the option for them to go up or down anymore. So when you sell your investments at a loss, you've officially lost money, and even though that investment might have gone right back up in value again, you've already sold. Option number 2 is slightly better because you're not selling your investments at a loss, but you're also not taking advantage of this time in the market. Now that's something that we have to explain more because it actually helps explain option number 3 and option number 4. Remember that we mentioned earlier how the market is always flipping back and forth between bear markets and bull markets, and how bear markets are quicker? Well, that's exactly why there's always going to be ups and downs in the stock market. But over time, the market trends upward. It literally lines up with bear markets, so shorter dips, and bull markets, so longer rises. This has been a part of the stock market cycle for many, many years now, and even though every bear market is different and caused by different things, and keep in mind that the past behavior of the market doesn't guarantee the future behavior, we can see that the overall stock market has recovered every time in the past and has gone upwards again. Now, on that same train of thought, the best days in the stock market tend to directly follow the worst days in the stock market. Here's what we're trying to say with all these facts. When the stock market goes down, it historically speaking is expected to go back up. And if you're not investing during the worst days in the stock market, then you're potentially missing out on the best days in the stock market.
Okay, so since all of that's true, wouldn't option number 3 be a good idea? To buy more investments than you usually would during this time? In general, we know that we believe in passive investing because it's proven to lead to the best result over the long term the majority of the time. Passive investing involves buying shares of funds like ETFs that track the market on a consistent basis, both when the market is up and when the market's down, aiming for a strong average return over the long term. That means that yes, you do want to be consistently investing when the market is up and when it's down, and buying when the market's down is actually a really important part of that strategy because that's when the prices to buy are lower, which brings your average cost down, which is a good thing. The only concern here is getting too into timing the market. Now, timing the market is when you try to guess when the market's at its current low point or when it's at its current high point and deciding when you're going to buy or sell based on that. Now, if we look at this past week and if you tried to time the market, if you were off the mark by a day or two, you would have had massively different results, right? So a passive investing strategy stays away from timing the market and instead goes for option number 4, which is continuing on with their usual strategy. Now, if we were to explain our usual passive investing strategy, it would be to consistently invest in diversified funds that track the market, both when it's up and when it's down, and also to contribute extra chunks of money whenever we have extra chunks of money. So would we buy even more investments during times when the market's down? Sure, if we had extra chunks of money, then we would. But that would be us using our usual strategy and not trying to time the market. Because if you think about it, even you trying to buy more investments is still you trying to time the market, right? It's potentially in a more positive way than you selling, but still. Now, a big thing for you to keep in mind during all of this is that it only applies to diversified passive investments, not individual stocks or more speculative investments that you're essentially betting on. When we're talking about the market's behavior, we're talking about the overall broader stock market. An actual individual stock could go back down and never come back up, especially if it's impacted directly by tariffs or other economic activity. But a fund that's full of potentially thousands of different stocks mitigates that risk. Now, specifically, globally diversified funds are something for you to make sure that you've looked into, and I feel like times like this are maybe something that's going to give you that nudge to actually go ahead and do that research. Also, keep in mind that your time horizon really impacts you too. A lot of what we said today is mostly relevant if you still have years to go until retirement, but if you're looking to retire within the next handful of years, then you want to really analyze your personal situation and make sure you know what's best for you and your specific situation to ensure that you're still in the position to retire when you want to.
Now, we know that there's probably been even more news between us filming this video and actually getting it out to you guys. So if you have any questions, make sure you let us know down in the comment box below. Now, on that note, make sure you check out our new investing course called Simple Investing for Canadians. It's something that we designed for long-term investors, but more importantly, we also designed it for this exact time period and for anyone who's looking to capitalize on these times where the markets are down and you maybe have no idea what you're doing or what you should be doing. If you're interested in learning more or signing up, make sure you check out our link in the description box below as well. And with that being said, we'll see you guys next week with another video, and yeah, make sure you check out some of our past videos as well.